A majority of the world's nations on Friday signed an historic pact that could force multinational companies to pay their fair share of tax in markets where they operate and earn profits. The 136 countries agreed to enforce a minimum corporate tax rate of 15%, an equitable system of taxing profit of big companies in markets where they are earned. The move is part of an evolving consensus to big multinationals and are funneling profit through low tax jurisdictions to avoid paying taxes, a development that made the Organization for Economic Cooperation and Development, comprising most developed economies, to lead the talks on a minimum corporate tax rate for a decade. Apart from the challenges of getting all major nations on the same page, since this impacts on the right of a sovereign to decide a nation's tax policy, the proposal has other pitfalls, as the global minimum rate will essentially take away a tool countries use to push policies that suits them. Well, to give us an in-depth analysis on emerging issues around this development is Mr. Vincent Okoukoni, a manager at Andersen Nigeria. Good afternoon, Mr. Vincent.
Good afternoon, Tolo. Thanks for having me.
Yes, it's good to have you join us to start the week this Monday. The conversation around global minimum corporate tax rate has been a front-burning issue for a while. We now see a major reform of the international tax system, finalizing with a minimum of 15% tax rate from 2023. What do you make of the lines of engagements, resolutions, and then its impact on the global business climate?
All right, thank you very much for that. Just a quick background. Of course, traditionally, businesses are set up with what you call a brick and mortar structure, where there's the need to then have some sort of physical presence in a particular location before you are then assessed to tax in that jurisdiction, right? But then with the advances in technology, we've seen several instances where companies can be in one location A and then carry on business activities in another location and make profits, which then gives rise to what you know as the digital economy, right? Basically the use of technology and the internet in driving business activities. And then the OECD, sometime in 2015, came up with a number of action plans to address some of these challenges with respect to failure to tax the profits of multinational companies, especially where they earn profits from jurisdictions where they are not physically present. All right. Now that we've had these agreements where 136 out of 140 countries have signed up to this deal to implement what is known as the two-pillar approach. For me, I think in a way you could look at it and say it's a welcome development, because the OECD has for some time been looking at ways to ensure that such activities of the M&As are properly taxed and that they pay their fair share of taxes in jurisdictions where they may not have a physical presence, but they have an economic presence. So on the one hand, we say it's welcome development to ensure that those multinational enterprises pay their fair share of taxes, all right? But then on the other hand, the question then arises in terms of implementation and administration and how we can balance all of this together.
As part of this landmark deal, we'll also see the reallocation of more than $125 billion of profits from around 100 of the world's largest and most profitable multinational enterprises to countries worldwide. What do you make of this reallocation of some taxing rights playing out, especially for home countries where multinationals run their markets and earn profits, regardless of whether firms have a physical presence there?
Yeah, thank you. So, of course, under Pillar 1 of the framework, right, Pillar 1 talks about, like you mentioned, reallocating taxing rights to local jurisdictions, as against the home countries of these multinational enterprises. But the point clearly is that, yes, you are in country A, for example, which is your home country, but your economic activities, your customers, where you supply to, where you sell your products and services, are residents in another jurisdiction B, for instance, all right? The idea is then to say, hey, because you are resident in your home country, of course, what's usually obtainable is to then have the taxing rights, allocated to the home country. But what OECD has come out to say now is that we need to take a critical look at your business activities, where exactly you have economic presence, and then allocate some taxing rights to those local jurisdictions talk about giving them something for where, for their roles. I mean, at the end of the day, these profits were actual, or some of the profits, were derived from those local jurisdictions. And talking about the amount that's going to be reallocated in terms of taxing rights to those local jurisdictions, of course, the key thing is for the OECD to then come up with what they've called an implementation plan, which will detail how exactly all of that will be achieved. Because, it's one thing to have an agreement and make a statement on paper, right? It's another thing to then have a robust and detailed implementation plan that would ensure that those taxing rights are duly allocated to these local jurisdictions to ensure that these multinational enterprises pay their fair share of taxes.
Now, do you share in the sentiments and, of course, optimism that this move will further bring benefits and stabilization of the international tax system and the increased tax certainty for taxpayers and tax administrations?
To a large extent, I would say yes. It's like I said, it's one thing to have to agree to sign up to this plan, right? As you are well aware, Nigeria is yet to sign as of today, and then the question then is, what's in it for me? Why do I need to sign up? What are some of the benefits that will be available to especially developing economies? All right. The OECD has published some guidelines and articles in terms of what benefits will be available to developing economies. Some of them include restriction of multinationals from making what you call tax deductible payments, such that they will then be able to allocate or move profits from low tax jurisdiction, from high tax jurisdictions to low tax jurisdictions. All right, and then we also look at creation of a lower threshold, for subjecting multinational enterprises to the corporate minimum tax rate of 15%, where the threshold is reduced from 1 million euros to 250,000 euros, just to cater for, specifically for smaller economies and developing economies around the world. So in a way, I would say yes, there are certain considerations for developing economies that could, become a benefit. But of course, it's important to take a look at the bigger picture, with respect to the minimum corporate tax rate of 15% as against what is currently obtainable in some of these economies, in terms of whether they have higher tax rates or whether there are already tax incentives that are in place in order to attract foreign investments.
Talking about the benefits, which is something I also like you to highlight, let's bring the conversation home. Addressing tax challenges arising from digitalization of the economy is moving at different pace than what we have here in Nigeria. What are some of our biggest mistakes from your perspective, and what reforms do you want to see in our tax systems domestically?
All right, thanks. So just to mention that currently Nigeria has a corporate tax rate at the highest band is 30%, and of course the focus is on big corporates and multinational enterprises. And that would, to me, represent a fair deal. If you recall, when we had Finance Act 2019, that was quickly followed by the Significant Economic Significant Economic Presence Order, SEP 2020 order, which came in after the Finance Act 2019, and then the focus then was to assess companies that render digital services to tax Nigeria to the extent that they have SCP. And some of the conditions include, meeting a threshold of 25 million advertising to Nigeria, or using .ng domain names and all of that. So that came in, and then the idea was then to subject non-resident companies to tax to the extent that they meet all of these, obligations and thresholds. But then the next question would then be, how effective has that been? In addition to that, when Finance Act 2020 came, there was a requirement for non-resident companies to file tax returns, just like every other Nigerian company, all right? But then in terms of implementation and how well we've done in terms of, actually bringing these NRCs to the tax net, maybe there's still some work to be done, all right? If you then compare the proposed or the agreed minimum taxes of 15% of profits of the multinational enterprises to our current taxes of 30%, you want to take a look at that and see how you can get a balance to ensure that you basically don't shoot yourself in the foot. Because if I have a current tax rate of 30%, why would I want to adopt a lower rate of 15% without, causing myself some trouble? And another point to then note is, some of the incentives that are available, right? So by the time you adopt the lower tax rate of 15%, for instance, you need to take a look at some of the other, incentives that you've put in place, to attract foreign direct investment. For example, the pioneer status incentive. You talk about grant of incentive, investment allowances, and what have you. So it's then to place all of these, considerations side by side as against adopting this global minimum tax rate of 15%, as proposed by the OECD.
With conversations and deliberations of the Finance Bill of 2021 in motion, of course, to accompany the 2022 budget, what sort of shifts do you expect with regards to revenue generation through improved tax systems?
Okay, so I think for me, generally, right, if you talk about improving revenue generation, it's good to have some sort of certainty, in terms of enshrining some of these recommendations and perspectives into the tax laws. So that gives some sort of a legal backing and certainty. All right. But beyond that, there's also the need for, of course, as a result of ensuring revenue generation and compliance drive, one of the key things that I believe would improve revenue generation will have to do with a lot of taxpayer education, as well as encouragement of voluntary compliance. Right? But with specific reference to taxing the digital economy as a result of transactions or services rendered by non-resident companies, it's important to have a framework, where you are able to determine, who has rendered what services in Nigeria, and then be able to determine the income or in other words, the profits, that are attributable to their activities in Nigeria. But because while it might be easy and straightforward to identify the revenue that NRCs generate from their operations in Nigeria, a bigger issue would then be, how do you then determine and allocate the cost, that was incurred in generating that revenue? Because at the end of the day, what you should be taxing, is the profit and not the revenue. All right. So one of the key things I would like to see is to have that robust framework that would effectively capture and bring into the Nigerian tax net the activities of NRC, so that we can have a workable plan, which of course already has a legal backing. Is then to have an implementation and process that would ensure that it's workable and it's practicable.
So do you see all countries keen into this as we move on? I think Ireland is also in this now. Do you see all countries keen into this new policy?
Well, at the moment, you have 136 out of 140.
So 4 to go.
You just have Nigeria, Sri Lanka, Kenya, and Pakistan. Well, it remains to be seen whether the remaining countries are going to key into it. But like I said, it's important for them to take a step back and analyze the benefits, potential benefits that will be available to them, to these jurisdictions that have not signed up, as against what they stand to lose. Because if you adopt and agree to this two-pillar approach that the OECD has proposed, just like the 136 other countries, you then need to do away with your own local legislation that relates to taxing digital services. Just like we have with the Finance Act 2019 and the SCP 2020 order. What it then means is that we need to do away with the SCP order that seeks to tax the activities of non-resident companies that provide digital services to the Nigerian counterparts. So it's about having a cost-benefit analysis of whether to adopt this approach or not, or rather to retain the unilateral approach of imposing digital services tax. But again, another key thing to consider would then be, what do you stand to lose in terms of potential trade sanctions, as against having a multilateral agreement, just like the other 136 jurisdictions that have signed up to this.
A very good one. I wanted to ask you, as wrapping up this part of the discussion, what are experts also like you, practitioners like you, what are your advices? What advice are you giving clients at the moment, particularly as we get fully out of COVID-19 pandemic and business is returning to normal? What kind of advices are you giving clients at the moment?
All right. So for us, right, it's important to comply as much as possible. At all times with the requirements of the law. All right. And then, so for Nigerian entities, for example, it's important to have a clear documentation of transactions with non-resident companies to ensure that, beyond the minimum tax, global minimum tax that's up for discussion right now, there are other compliance requirements for Nigerian companies that have business dealings with non-resident companies. For example, there's the requirement to surcharge for VAT on transactions with non-resident companies where the non-resident company has not included VAT in its invoice, for instance. And then there's also the requirement for non-resident companies to register for taxes in Nigeria and then file annual returns where applicable, just like every other Nigerian company. So for us, it's important to then let our clients know and give them advice and education to ensure that they comply with the requirements of the law and they are not found wanting in any way.
It's really good to see you this Monday. Thank you so very much, Mr. Vincent Okoukoni, manager at Andersen Nigeria.
Thank you, Tolu. Have a good one.
All right. Enjoy the rest of your day.